they have a huge amount of revenue. But remember, margin of safety matters. But the risk is that they created stickiness. That's a really great thing. And that's going to be good for shareholders. Imagine that, being paid to wait. That's the key here. All right, guys, Apple yesterday hit a 52-week low intraday. Yep. Mo, what was that? What was that price?
128.72.
Okay, and right now it's 129.79, so about $1 off of that. Now, we have said before in many videos that we believe Apple will be the last stock to have capitulation. This bull market has kind of made people feel like Apple is untouchable, right? Yeah, it's kind of like, hey,
place to go for shelter.
This is the place to go. This is where safety comes. Now, remember, when it comes to long-term bull and bear markets, we need to see people give up on the most secure type of investment. Apple seems to be the one that everybody believes in. And I think a big reason for that also is Warren Buffett is a big fan of buying Apple stock. At 129, he is definitely buying Apple stock. I believe, based on the things I've seen, I believe 140 is his buy price. I don't know that to be 100% fact, but I've seen in terms of timing of when he bought and when he didn't buy, et cetera, I think 140 is the price. Now, Warren Buffett has said before that he and Charlie tend to have a higher intrinsic value when it comes to companies they buy them. So let's go through our 8 pillars, go through Apple. I also want to sit there and look at our options and how you can make money getting paid to wait for Apple stock to fall before we do our stock analyzer tool and determine what we want to pay for Apple stock. Mo, any comments before we go?
No, let's see how low this can go. So, by the way, from the looks of it, the Berkshire Hathaway, they filed a 13F 1231. So just a few more days, we'll see if he's buying more Apple.
Yeah, and the problem is, when the 13F, does it tell what price he paid for it, or that he just holds the stock?
Double check. All
right. So, a couple of key attributes for Apple. One thing is, look at the difference between market cap and enterprise value. Essentially, and I'm not going to get in the math of it, essentially the difference is debt. So it's a very low debt number for the company. 43% gross margin, but look at this profit margin. 25 over the last year, 23.5. I mean, this is the difference between gross margin and profit margin is taxes and overhead. They run it's also has to do with the fact that they have a huge amount of revenue, right? Now, this is what we think Warren Buffett loves right here. This high return on invested capital. We don't think it, we know it. Warren Buffett's play is, he wants to get Tim Cook to keep buying back more and more shares. As they buy back more and more shares, you're decreasing the amount of invested capital in the business and getting a higher return. And that's going to be good for shareholders. That's a lot of value investors considered ROIC, return on invested capital, to kind of be like the moat or the quality of the business. Because a good quality business with a good moat can sustain a really high return on the money that's invested in the business. The market average is about 10%. We want over 5% on the 5-year level. It's at 39%. So it's a very, very strong number. Very small dividend, 0.7%, but because of their market cap, it eats up $15 billion of their free cash flow.
That's amazing.
What's up, Mo?
That's amazing. No, I'm just laughing
that incredible?
About the dividend. I always laugh at the dividend price paid of 0.7%.
I know. It's adorable.
Yeah.
So let's go to their 8 pillars here. All right. It's an 8 pillars that we like. Now, we have a check mark on everything except for our 5-year PE and 5-year price of free cash flow. Does this mean the stock is overpriced? Well, we don't know. And the example I always give is, guys, these should go higher based on a higher growth rate and or a high return on invested capital. They already have a high return on invested capital. So let's say for a growth rate, if you had 2 companies with these exact metrics, one was going to grow 5% a year, one was going to grow 40% a year for the next 10 years. Which one would you pay more for?
40%.
Absolutely. And that's kind of the idea here. You can't just go off this and say, this is too much. This is too much. No, you have to sit there and say, okay, well, what are we looking at? How's it looking there? Let's look at analyst estimates just to show you the growth potential for the company. Now, they're able to grow their earnings per share at a slow rate, but reasonable, mid-high single digits. Okay, fine. But look at their revenue growth rate. I mean, it really plummets here based on estimates. And remember, these are analyst estimates. I want everybody to remember, though, that with inflation, that revenue growth number is going to go up. Like if inflation is 7% or even 4% a year for the rest of the time, if they just keep maintain their market position, the cost of their iPads and iPhones are going to go up at 4% a year. Yeah. Right? So you sit there and say, okay, well, when looking at a longer term growth rate, I think these are too low, unless the business is declining.
Yeah, it doesn't seem like it is.
I mean, it is the tech business, but they've done a really good job of making us fall in love with their...
Then they've created that ecosystem.
Yeah, they've created the ecosystem of people staying with them. They created stickiness. That's a really great thing, all right? So from this perspective, let's say hypothetically, and I'm not saying you should, let's say hypothetically you're like Warren Buffett and you want Apple stock at 130 or below. Here's how you can make some money being paid to wait. Now, the catch here is you need to have 100 shares that you want to purchase. You can do some other things, but let's assume you want to buy 100 shares of stock. You pull up options. Let's pull up the options change for Apple. You want to do what's called selling a put. So for those of you who are new, I really want you to not worry about if this sounds confusing or not, because the first time I heard about options, I was like, wait, what? I was very confused. But here are the basic things I want you to understand. One, only sell puts at a price that you absolutely want to buy the stock at.
On a company you want.
Right. So Mo interacts with a lot of people in our oracles of everything money.
I accept.
Oracles of EM. And he talks about selling puts. The thing that a lot of our users and our thousands of people in our software community do, we always want to encourage them, do not sell at a price you don't want to own it at. You have to be okay buying it at that price. And the idea is this. You select a date in the future and a price. And your comment is, I'm going to buy it anywhere along the line. So if I get paid to wait for that, I'm good. So for example, let's say your date is January 20th of 2023. So a month from now, not even a month from now, 24 days from now. And you want to buy Apple at $120 a share. What's going to happen is they're going to pay you somebody's going to pay you $1.57 per share to get that stock on that date. Guys, the delta is 0.2. This means it's about a 20% chance of that happening. But guys, look at this return. You get $1.57 and your risk is $120. You're getting 25% return for 24 days. That's incredible. That's absolutely incredible. So what does that mean? That means you're essentially, what's your annualized return there? Your annualized return is let's do the exact number. $1.57 divided by 120. It's 1.3%. Divided by 24 days times 365. That's an annualized return of 20% per year. So what does that mean? That means if you did this over and over and over again and never got assigned the shares, that means that Apple never fell below your strike price. In this situation, it's 120. Then you would make 19.58% of your money. Yep. It's a great way to get a return, above average return on your money. And for a company like Apple, that's a hard thing to do to get these kind of returns.
Yeah. Usually on companies, you would be paid 57 cents for that.
So let's look at, like, for example, $100. Look at how much it drops for $100. Now, granted, same date, January 20th, and now you're saying I want to buy it at $100. Of course, you can get paid a lot less. It's 18 cents. Divided by 100 is 0.18%. Not 1.8, 0.18%, which is an annualized return of, divided by 24 days times 365 days in the year, 2.75%.
But the risk of you getting assigned those shares
goes from 20% down to 2.5%.
Exactly.
But remember, your cash is better off sitting in a 90-day treasury, because 90-day treasury, as of this morning, was paying 4.4%. So my recommendation is don't do this unless you're going to get a really high. For me, for puts, I want to be high single digits on big companies and mid-teens on smaller companies at far off dates. That's the big key here. So for a company like Apple, wait until it's within, 10 or 15% of the price you want to buy it at. So what's the catch here? Well, guys, in my opinion, there is no catch. Why? Because what you're doing when you sell that put at 120 is, I'm buying it at 120. I don't care when it hits. But the risk is that on the strike date of January 20th, it's at 110. You still have to pay 120 for it, but you get to keep the $1.57 they gave you. So your real basis is at 120 minus 1.57, so 118.43. Remember, you were going to buy it at 120 no matter what. So to me, if I was buying it at 120 no matter what, I just got paid $1.57 to be able to pay 120 for it. That's the key here. And it's worked out very, very well for Mo and I. We've bought shares of companies we like. And the other reason we like it is it keeps us busy. We don't have to sit there and force ourselves to buy a company just because we want to be active. Right. It allows us to get paid to wait. So now the question is 120 a reasonable price for Apple stock? Well, everybody's going to have their different assumptions, but let's go in here and use our stock analyzer tool. Now, Mo, Which do you want to do? Mo and I, what we like to do is we like to do 10 versus 20 year analysis. And by the way, for those of you who are confused, please rewatch that part of the video. It's very important to understand that. And guess what? It's going to be confusing for a while because to wrap your head around being paid to wait and buying the stock no matter what price it hits, it does take time. It took Mo and I some time.
Yeah, it took like four times getting through it or something.
And then we finally...
It's just repetition.
Yep. And then now we do it like it's nothing.
It's a little counterintuitive at first.
Yes.
And then you figure it out. Just like everything else.
Right? So we're selling a put to buy a stock at a price at a future date, lower than where it is today, but at a price we want. Yep. Imagine that, being paid to wait. I mean, let me show you an example. Heck, you could even go out, let's say to the end of next year, December 15th, 2023, and you wanted $80. Someone's going to pay you $2.42. And the downside is that's only a 3% return because 2.42 divided by 80 is 3%. But you're getting the stock at $80. It's not bad. The question you have to ask yourself is, would you rather have money in 90-day treasuries making 4.4, assuming the 90-day treasuries stay up that high?
Right.
Because if, let's say, for example, the Fed decides to all of a sudden cut rates to back to zero again, you're getting 0% return.
Yep.
All right, so Mo, back to Stock Analyzer tool. Do you want to do 10-year or 20-year analysis?
What do you want to do?
I want to do 20.
Okay.
So the reason I do a 20-year analysis is I'm really starting to focus on owning companies for a very, very long period of time. So we're going to put our assumptions in. And our assumptions are going to be revenue growth, profit margin, free cash flow margin, PE, price to free cash flow, and our desired annual return. That's the big key here. Desired annual return. Okay, so the assumptions we're making here, guys, the hard part is we don't know what assumptions you're going to make, and everybody's assumptions are different. You're going to see that Mo and I are going to make very different assumptions, and every time we do a stock, we do different assumptions. The key here is Apple's selling at $130. We shouldn't come up with $300 for our high price one time and $100 for another time. It should still stay around some certain area, but our low, middle, and high is going to vary based on our assumptions. And I want to have those wide assumptions. Mo, what did you do for revenue growth for your 10-year assumption?
6, 9, and 12.
Okay, I did 3, 6, and 9 for my 20-year. Okay. What'd you do for your profit margin?
21, 23, and 25.
I did 20, 22, and 24. I don't disagree with Mo's, though, because as they do more subscription, it's going to be higher margin, and hopefully they're able to get in a higher margin business with that. Right. Free cash flow margin?
24, 26, 28.
I did 23, 25, 27. I think it's the first time ever I've been less. I think your Apple bias is showing up here.
Yeah.
PE versus price.
I'm factoring in a lot of, they're switching to a subscription-based business.
Well, I think that would, oh yeah, it's true.
More so.
You're true.
Yeah.
PE.
14, 16, 18.
I did 15, 17, 19.
Okay. 14, 16, 18 for price to free cash flow.
Desired return?
12, 13 and a half, and 15.
Exactly the same. Now, guys, let's discuss this. To me, Apple's such a large company that your desired return, unless you're making obscene assumptions, shouldn't be that high. 15 is an ample return for these high assumptions because this is less likely to happen. This is essentially your margin of safety here because you can get 9 or 10% for the market. So that should be your baseline. The higher your desired return, the more margin of safety you have because in order to get a high return, you have to pay less price. And paying less is your margin of safety. Okay? So we're going to hit the analyze button. Now remember, my analysis is 20 years. Mo's is 10 years.
Okay.
All right, Mo, what'd you get?
I have 80 to 91 on the low end, 137 to 154 on the high end, and middle ground 105 to 120.
Okay, I have 60 to 70 on the low end, 110 to 120 on the high end, 80 to 90 in the middle. All right. So where do we stand? Can you justify 120? Yeah, you can.
Yeah.
There's a way to justify 120, but remember, margin of safety matters. So your job, there's a reason why this stock analyzer tool has been used over 1.2 million times this year by our users. It's because it's a great way to say, hey, if every investment's the present value of all future cash flow, what is this investment worth to me? Now, granted, this does not factor in the balance sheet. But guys, use this tool. If you're interested, sign up for our software at everythingmoney.com. You'll join the thousands of people in here that talk about investments every day. And we have a risk-free guarantee. Sign up. If within 30 days you don't like it, email us. We'll give you a money-back guarantee. No questions asked. Thanks very much for your time.